Hello, everybody. Today is Tuesday, March 8th. Bob and I wanted to give you a little bit of an update on what is going on in our heads as far as your portfolios go. We're in a very fast-moving global economic situation at the moment, and thought it best to communicate a little bit more directly with you. So we want to give you a little bit of thoughts on what we've done lately and where we're heading. So Bob, I'll let you go from here.
Okay, that sounds good. So we're going to hit a little bit about the current economic environment. Obviously, pretty fluid situations going on right now. As with all of these sorts of situations, it's going to require a little bit of patience. Our explanatory power is relatively low in the very immediate term, but longer term, it tends to be a lot stronger. Then we're going to hit on the changing interest rate environment, both the 10-year yield and the Fed funds rate, and then we'll kind of get into our more immediate response to things. So one of the things that's been going on is interest rates have sort of been all over the place lately. We recently came back off of being north of 2% on the 10-year, back down to 1.72. As happens in times like these, interest rates have now shot back up to about 1.85% on the 10-year. What's interesting about that, and one of the reasons why we've been holding cash instead of, we took this dip in yields to move a lot of the money into cash rather than hold them in yields, despite the strong sell-off in markets yesterday, where Treasury yields are supposed to cushion you from these sell-offs as a negatively correlated asset. We've seen what's happening right now is extremely inflationary. We know the Federal Reserve is starting to tighten monetary policy, and Treasury yields have been going higher and bonds have been going lower, despite the fact that stocks are selling off. So that's a big reason for our move. We continue to expect Treasury yields to go well north of 2% before the end of this year. And so, we are using cash as our defensive positioning instead of the 10-year Treasury bond.
Yeah, and our move last week was right where this chart says. We liquidated most of our government bond positions at that 1.72% rate. So fortunately, the timing was very good on that.
That was good. One of the important reasons, too, that we're moving to shorter duration, right? That means less interest rate risk, and moving from the 10-year down the curve, as we say, to the 2-year and shorter, is if you look at the slope of the yield curve, right? The steepness of the yield curve. If we had our money in cash over the last several years, you'd be making 0% versus yields on 10-year were 1 or 2%. It made a lot of sense for us to move out on the yield curve. What's happened as the Fed has started to tighten is that the yield curve is flattening, meaning we can get the same yield on a 2-year Treasury right now as we can get on the 10-year Treasury. So the need to take on that interest risk is becoming less and less, because there is no real yield advantage to moving out or adding duration to your portfolios. We can see this is the Fed funds rate future. It is anticipating, right? It's a future, interest rate future is anticipating what the Federal Reserve will do with interest rates. We can see that it's been at 0 for a long time, but now they're saying the anticipation is these are 1-year out futures, is that a year from now, the anticipation would be that the Federal Reserve will have short-term rates at 1.25%. So that's about a 1.25% raise over the 0% that we're at. They've recently backed off that a little bit, and that future's dipped again just slightly. But the overall theme that can't be lost, whether it's 1.25, whether it's a 1.5 or 1%, is that the Federal Reserve is raising short-term interest rates. So as the Federal Reserve raises short-term interest rates, that yield curve is going to continue to flatten. Longer-term yields will go up and likely lose value on those longer duration bonds. So that's why, again, we're shifting your assets into cash on the fixed income component, because we're able to earn the same yield and retain the value, even though we're in a rising interest rate environment. This is a study we recently did, and we're comparing the current environment to these studies. The one thing that really comes out of looking at global conflicts, et cetera, is they're not necessarily horrible long-term to market appreciation stocks in particular. They are extremely inflationary. They're extremely inflationary for several reasons. One being that global trade dries up very quickly. Two being that peacetime operations of providing more consumer goods and services declines, the private sector production, and public sector production increases, primarily, military buildup, etc. So these periods are extremely inflationary. We put the Cold War in the middle of this screen because this is really what we feel like we're hitting right now is more of a Cold War, right? It's not a traditional war or traditional warfare, but what it does do is it does greatly restrict global trade, and we see these inflationary pressures we're obviously seeing right now in energy prices. We don't think that this is the next great war, but when we look out, there are similarities on this piece. If we, again, examine what do these conflicts mean, with the exception of the Great War, Civil War, World War I, World War II, et cetera, and the Cold War, all of these shorter regional conflicts, assassinations, terrorism, et cetera, tend to cause extreme short-term volatility, but ultimately not impact the long-term variables that affect how markets are priced. And that's really what we're seeing right here. In the short term, we are getting hit pretty hard. Earnings are going to get hit pretty hard by these higher energy prices. Higher energy prices decrease consumer discretionary income, so the money the consumer can spend. It also increases the cost of production for companies and lowers their profit margins. We expect the next period here to be a somewhat difficult period. Stocks have already sold off quite a bit, so valuation is reasonable. But we do think that 6 months to a year out, things will turn around and continue to appreciate. We don't have a crystal ball, or in the short term, we have to recognize we really can't overly explain what's going to happen. This war could go in many, many different directions. In the short term, there's going to be a lot of volatility. Longer term, when we look at what this conflict is doing, we expect supply of energy to increase, the price of energy to come down, and the economy, at least domestically, to continue to be okay. In the immediate term here, we really don't know what's going to happen. There could be news flow that could make stocks dip even more. There could be news flow that could make stocks pop up a little bit. But we are keeping our neutral equity weight at this time. We have shifted away from assets that are going to be overly hurt by inflation, primarily moving a lot of fixed income into cash. And we just think it makes most sense right now for investors to continue to remain in their 100% domestic portfolios, tilted towards value and lower duration, and just to keep calm and to carry on. And a year from now, we expect portfolios to be higher than they are today.
And I'll just add, as Bob and I have been talking a lot about this, and over the course of the last 2 weeks, a lot of economic metrics have changed, as he has said. So we are reevaluating all of these issues over the course of the next week, and you may not hear much from us over the next week, but we are going to work on our analysis again and come back to you, hopefully with our next steps with this investment plan. But I would remind everybody that we are all long-term investors. Bob and I and our teams are invested the exact same way you guys are. So we're taking a very hard look at this and are continuing to focus on the long term. And in the long run, we're optimistic. In the short term, we need to figure out a few things. So we will continue to stay in touch and communicate with you as often as we can. And please, if you have any questions about any of this, call any of us at any point. Until then, have a great week, and we'll be in touch.
Have a great week, everyone.